One of the hardest things for any technical analyst, or for trader for that measure, is the ability to understand when turning points are actually occurring. It's very easy to see them in retrospect and say, oh, here was a significant high or low, but often there are times when markets coordinate with each other and those big turning points occur. And so it's important for traders, or good traders, to try and attempt and work out one of the times when this is actually happening. Now, in previous blogs and videos, talked about a key philosophy, which is that markets reverse or accelerate around holidays. And we had Easter holidays about a week ago, and in truth, not a great deal happened afterwards. One of the few markets that made a move was soybeans, which in the front months moved up and accelerated upwards, but that was not reflected in the new crop or the November contract in the same way as the bull market of around last year or 18 months ago occurred, whereby the new and old crop were moving in equal measure. However, now that we've had a week of reflection, and the fact that the markets for much of this year have really had a very strong correlation with the S&P, we can look at the S&P and the Dow and see that there's some instances to say that we're on some potential turning points. Now, I mentioned on CNBC about a month ago that the S&P was above 807. It was bullish. There was no longer a bear market. And I was looking for momentum to slow on the upside and there to be volatile sideways. The volatility hasn't really been as great as I thought it might have been, but momentum has definitely slowed. And now we're at a point where, from a resistance point of view of both the Dow and the S&P, we can look to see whether that turning point is now occurring now. And this has implication in other markets, and when we look at some of those other markets, we'll see that they potentially have done timing-based signals to say that trends are changing. First of all, we're just going to look at a concept of that correlation, and this is the S&P against the dollar against Canada on a daily basis. And what has happened is we have a continuing, almost perfect decorrelation. So what we mean by that is when the S&P goes up, dollar Canada goes down. Now the problem is that the S&P isn't always at very important levels that are easy to trade from, and so it means that trading some of the what I call non-primary instruments associated with the S&P, it can be quite difficult to take a day trade or a 1 or 2 day view. However, for those who don't like the volatility of the S&P, you can trade the dollar Canada based on the S&P, and it's going to be a lot more of an easier ride. First of all, we're just looking at the Dow Jones, and this is the previous trend from the summer of last year, or late summer, early autumn, and this is the uptrend that began in March. And we can see that once we started trading above 7,750, we were going into a higher distribution, which was positive, but we would expect the momentum to slow purely because of the weight of time that had been spent there previously. We've stalled quite a considerable distance ahead of the pivotal point, which is control. However, if we look at the same distributions on the S&P, the nature of 807 is very, very clear here. And what's happened now is we've actually come higher and moved directly to the control area, and thus far we've stalled. For us to get truly bullish and say that there was another leg higher, we'd have to get above 872 into this 890 area and then really start trading above 936. As it stands, from a technical perspective and the way that we look at markets, the market has purely come to the optimum point for strategic bears to get involved, which is the control point. If we were to reverse and then holding value below 807, this would signal that we then had the opportunity to trend back down and start looking at areas around the 738 area at the very least. Now, not only is the S&P at a critical point, on certain currencies, primarily the euro-dollar and the dollar against the Swiss franc, then also some very important things happened on Friday. Now, 130.90 has been a very consistent reference point on the euro-dollar. When we started holding value above it, then we could extend higher, and we came up towards the distribution highs at around 137.5. Now, on Friday, we traded below 130.90 and we actually closed below it. I'm always a little bit wary of closes on foreign exchange that are at extremes because of lack of volume, and it could be a false move. However, today has told us exactly all we need to know, because price has topped out effectively around that distribution high point and the distribution low point of here, and we've moved down quite aggressively. The key is to go below 128.80 and start trading and closing below there, which would signal the next downward leg into the mid 125s. Critical things also happened on the dollar Swiss on Friday. This was the trend that had been down, and this is the previous trend. And often when markets decide that they suddenly want to trend, control takes prominence. And on Friday what happened was the market came down, just held above control, and then accelerated higher. It's now above the control of the previous trend at around 116, and is now finding itself within the vacuum of this area here. Key support is that 116 point initially, and we would have to go below there and then go below 114.40 to say that this move is false. In the short term, there's very little resistance. Because we didn't spend much time up here, then there's little to stop this rally accelerating. The correlation that has occurred between the stock market and currencies has been that when the stock market is weak, then the dollar is strong. And so this backs up this theory that the currency markets are making a move based on the S&P and on their own technicals as well. Next we're looking at gold, and gold, as far as I'm concerned, really underperformed through the beginning of the year when the stock market was very weak. Gold could not muster and hold above $1,000, and since then has been performing pretty poorly, and the technical picture has deteriorated further over the last couple of weeks. We had control of the previous trend from February last year that was at 900 to 901, and then the current distribution from October last year had also created a control area around 916. Now the key thing really again on Friday was the fact that the high was at 899, which coincides with that control area. As you can see there. What is slightly worrying for people who may be long gold, and I know there's plenty of gold bugs out there, is the fact that if we start trading below 855, there's not a great deal of support. We have some minor support around 806, but really there's very little there. One thing is for sure, it would be interesting to see whether the correlation that occurred earlier on in the year, which was stock market down, gold down, which normally would defy conventional logic, actually takes hold again. For today, when the S&P is down, then gold has rallied about $10, but it's not in a particularly positive framework. Key really there is to be a seller really from about 897 up to that 917 to 920 area, or to look for the breakdown below 855. All in all, it's not a good technical picture on gold. Finally, and for some somewhat bizarrely, a market that I look at relatively closely is the Taiwanese stock market. And one of the reasons for that is the fact that it appears to be, again, for a reason I don't really know or understand, and to a certain extent I don't really care either, is the fact that it tends to be a leading indicator on the American stock market. It's very interesting that when the American stock market was falling aggressively through March, the market actually made its low a considerable time before then. So it was not falling through March and actually started rallying some time before. Now what's happened in the more recent past is we've gone from a low of 150 all the way up to 220, so we've had a huge rally in percentage terms. And on Friday again we had a major turning point. From out of nowhere the market moved significantly lower, and if I merge the current trend in from those lows on the 5th of March, control has moved to the top of the trend. Now this is a timing point to say that a new trend is due, and the fact that the market is overbought on a historical basis means that any further upside has to be treated with caution, but more importantly it leaves the opportunity for the market to become what I call top heavy and then go on an extended slide. The first catalyst through this would be to start trading below a 208.5. Now I know it's not necessarily easy for people to trade Taiwan or even look at it that closely, but if you can, I would keep an eye on it and see whether it is extending losses lower. Certainly if it started trading below 193, then again there's very little support in the same way if the S&P starts trading below the 807 to 803 area.